Welcome to Barenaked Money, the podcast where we strip down the complex world of finance to its bare essentials, with your hosts, Josh Sheluk and Colin White, portfolio managers with Verecan Capital Management, Inc.
Welcome, everybody. Josh and Colin here to have a little bit of chat about how great the summer is going and how wonderful markets are and how we're obviously going through the best soft landing in the history of soft landings. Did I get that right, Josh? Is that what we're going to talk about?
Soft landing, is it a unicorn or do we call it a different mythical beast?
I'm not sure. Pegasaurus has always been one of my favorite mythical beasts. Like if we're going to go down the mythical beast spirit animal route.
Is that a real thing, a Pegasaurus? Or are you talking about a Pegasus, or is this like a Pegasus and a dinosaur crossed?
We all had our own imaginary friends as we grow up. Don't be so judgy.
Fair enough. Yep, that's right.
So what do you think, Josh? Is all of the great news last couple of weeks and your awesome performance on the investment side last couple of weeks indicative of we've reached the inflection point, the turning point? We should all relax. Is that where we are?
Well, so I guess a soft landing isn't quite as unprecedented as I made it sound at the outset. There have been some periods through history where we've seen rate cuts and inflation come down, and although things seem to be slowing or weakening, they can continue on for a long stretch in this situation. So it's possible. I don't think it's a high probability event that this continues like this for a sustained period of time. So that's where we are. As we always do, we're predicting the future, so we just try to rely on probabilities, and it's not a very high likelihood, especially here in Canada where you see quite material weakening economically. It's not a high likelihood that we're able to sustain this for a long period of time before dipping into some real weaker growth numbers, I think.
So would it be a fair characterization to say that do you think there's still a little bit more pain ahead?
Well, we haven't had much pain. So when you say more pain, I don't know what you mean. More pain than nothing?
Josh, you're underestimating how worried we've all been.
Yes. No,
worrying causes pain. I mean, we've worried ourselves into 2 or 3 recessions recently. And then when they didn't show up, we invented micro recessions to
emotional recessions. Emotional recessions for sure. Yeah. I think it pays to be cautious at the moment, is what I'd say. And that doesn't necessarily mean that there's going to be some real pain or anything out there. But I think, again, the likelihood or probability of some pain is higher than you would think otherwise. So it pays just to be a little bit cautious with your portfolio positioning. And if you need money over the next year or two, maybe be a little bit safe with that.
Yeah, I think that, from what I see, there's pockets where we expect more pain. I think that the Magnificent Seven still have a rocky road ahead now. Again, whether that's in the next 6 months or 6 years, as you so admirably pointed out, eventually valuations have to matter. Now, that could be 6 years from now, but eventually it has to matter. So I think that there certainly are areas. And this is not a great market, in my opinion, to be really, really super confident about a particular outcome and place a significant bet in one direction or another for sure. I think diversification is actually paying off quite nicely right now. And I think that's going to continue to be the case. And, leaning into the wind a little bit. And maybe there's room to play with your duration on your fixed income side. Maybe there's room to play with your concentration on the equity side a little bit. But don't get crazy. I'm of the opinion that, this feels a lot like a soft landing. And I define a soft landing as one that does not end up with a meaningful recession and, allows us to push off the bottom and move higher again. So it's kind of a loosey-goosey definition. And it would be a little remarkable, given the sledgehammers that we have to change direction. Like, it's not like we've got a full control panel in front of us with lots of dials and knobs that are immediately responsive that we can tune the economy to where we want it. We really have these bludgeoning, blunt instruments, like rate cuts and speeches by important people. And, so there's no real fine tuning of this. So it will be a little remarkable, in my humble opinion, if we do manage to bring this into a situation where we don't end up in urgent rate cuts. I was going to say panicked, but panic's not the word. I think what we're hoping to avoid is that we end up in any kind of a situation where we're urgently seeing economic reactions to things.
Yeah, you mentioned the sledgehammer. The sledgehammer was interest rates increasing by 5% in what was it, a 3 to 6 month period of time, like very, very abruptly, right? So
Yeah.
that is very unusual to have interest rates move that far, that fast, off of also basically zero. So that's never happened. So to say that that's not going to have any ramifications down the road, we'd be living in the mythical universe, I think, that we talked about at the outset. But I think you mentioned, sorry, go ahead if you have a point on that. Yeah. Well, I was just going to bring it back to what you mentioned about the Magnificent Seven or whatever. The largest cap stocks in the world have really dominated the headlines and the performance so far again this year. And just a couple of data points that I've seen recently. One, and I'll try to source them properly here. A company called Empirical Research said that in the 100 some odd year history of the S&P 500, the index has never been up more than 10%, with one stock delivering 30% or so of that return. And that's Nvidia this year. S&P 500 up over 10%, well over that actually. 30% of that responsible just from Nvidia itself, the one company, which is quite remarkable when you think about it. And this company was already one of the largest companies in the world coming into this year, and it's gone up dramatically since that. And then the other thing was from Ned Davis Research, and I told you about this already, but I'll say it again for our listeners. So there's only been 2 periods of time when the largest 7 companies in the world have outperformed to significant extent over an extended period of time. The first was in the late 90s, didn't end well. The second is now. And I don't know how it's going to end, but it tells you that there's some embedded risk in being aligned with those largest 7 companies or with the index as a whole or the best performing parts of the market over recent times.
It's just funny because in that explanation and what these commentaries are, they talk about how things end. I think it's important to point out things never end. The ball keeps bouncing. Like, the market moves, the economy moves. It's just the size and magnitude of the dips that you're going to go through. And, we in Canada, of a certain vintage, have Nortel to look back upon, where one company was well over 35% of the index at one point. And, now not to say that Nvidia is going to go bankrupt like Nortel did, that's not my point. But that is an illustration of the inherent risks when you have a market dominated by key players like that. And it's a risk to be managed. I don't think that FOMO kicks in and, the sex appeal picks up and the hype picks up. But you really have to be, careful about being influenced in that way. That's a real dangerous place to put yourself. And back to what I said earlier, I think diversification is key. Now, part of me wants to argue with myself because I've seen a lot of products coming out lately, a lot of emphasis on product about, equal weighted rather than cap weighted. So part of me is thinking, well, wait a second, product normally gets launched at exactly the wrong time. So maybe now's the time to double down on the Magnificent Seven. Maybe, so that contraindicator for me has kind of sparked me today. I was going, oh no, people talking about this. Well, maybe we should lean in. I'm confused. I'm not sure what to take from that.
Yeah, well, not every product can be launched at the wrong time, can it?
Well, that maybe was my belief earlier this week, but as the week has gone on, I said, wait a second, maybe they're talking properly now. Maybe we are living in a mythical land with soft landings and Pegasuruses. So maybe the product launches are now going properly. Maybe this is a complete break of the time-space continuum.
That's right. Yeah. So yeah, we're at this point today. Economies seem to be weakening more so in Canada than the US. Inflation, we're getting pretty solid, consistent data now where it is within range or within spitting distance of range of where we want to be. And the markets keep doing well. So it is a nice place to be right now.
Well, it kind of strikes me as that we were inevitably going to get here. This is where all of the actors in the market wanted to see this happen. The central banks wanted to see this happen. Governments wanted to see this happen. We were going to get here. Now, I think a lot of the
When you say
consternation is about
here, you mean weaker economic growth and weaker
exactly,
inflation. Yeah.
exactly. So we were gonna see the slowing. It was, to me, it was inevitable we were going to see the slowing.
Yeah.
And I do think that we're just quibbling about the details right now. And this was kind of inevitable to get to this point. Whether it gets a little bit worse from here, yeah, there's an active debate that we could have on that. And I probably agree with you. This probably is going to feel a little worse, right? Is it quantifiably going to be worse from here? I don't know. It's going to feel a little worse at some point for sure before we start up the other side. But there's an inevitability to this, and to see the range of see the magnitude of the reaction to each of the little individual steps as we get here is the part that I think is a little out of step with maybe how much we should be reacting to these things. But I'm comfortable. I'm having a good summer. I think it's going well.
Yeah, me too. And I guess our takeaway is stay diversified, stay maybe a little bit cautious, just keep one eye open. Is that fair?
Absolutely. Cautious is always good, because remember, it's not about making a lot of money. It's about keeping what you got. So protecting the downside is way more important than hitting it out of the park. If you're breaking a sweat trying to figure out what your financial advisor is talking about, you're not getting the service you need. You probably hate trying to get an answer from them, but you also think moving your accounts will be a headache, and it might be. But working with don'trocktheboatwealthplanning.com or .ru isn't exactly stress-free, is it? Call us. We will demystify the world for you.
At Verecan Capital Management, Inc., we focus on aligning our goals with yours, prioritizing integrity and transparency. For more information about us and our services, please visit our website. Thank you for listening, and let's continue to challenge the norms of the financial services industry together. Please note, the information provided in this podcast is for general information purposes only. It is not intended as financial, investment, legal, tax, accounting, or other professional advice. Our discussions are not a solicitation to buy or sell any securities or to make any specific investments. Any decisions, based on information contained in this podcast, are the sole responsibility of the listener. We strongly advise consulting with a professional financial advisor before making any financial decisions. Listeners should be aware that investing involves risks and that past performance is not indicative of future results. Barenaked Money is produced by Verecan Capital Management, Inc., a licensed portfolio management company in Canada. We operate under the regulatory framework established by the provincial securities commissions in the provinces within which we operate. The views expressed in the podcast are our own and do not necessarily reflect the official policy or position of any regulatory authority.